I think given what's happening in the industry, I think it's quite a good timing in terms of emphasising in terms of what's going on in our industry, and I guess in terms of those key discussion points around the importance of people to keep focused on the positives, rather than get stuck in mainstream media in all the negatives that mainstream sell, right? And I guess we all play a role collectively here to keep those positives going, right? In terms of what's happening. So look, in terms of the, probably from an introduction perspective, we'll go around, introduce ourselves, and just a brief overview in terms of who we are. And so then people got a grasp in terms of our backgrounds, and obviously in terms of our relevance to the topic. Again, I'm LuisMiguelAleixo. I'm the Managing Director and co-founder of Practising projects. We tokenize real estate property here in Australia, focusing on luxury investment properties is our focus area. Klaus, over to you. We'll go around in my sequence.
Thanks for inviting me here. Thanks for inviting me here. Always a pleasure. My name is Klaus. I'm the CEO of DigiShares. I've been in the blockchain space for 6-7 years now, but we started looking at tokenization about 5 years ago, I think, and launched DigiShares about 4 years ago. So today we are fully focused on being sort of a pure tech provider. We provide a white label platform for tokenization of real world assets. We've got, I think, around 120 clients now. The majority in the US. The US is our biggest market, but there's a global interest in doing this, and we see still, I would say, normal levels of demand, even through the crypto crisis.
Fantastic, Tron.
Yeah, so my name is TronBlack, and I've been in crypto price since about 2013. And then I was lucky enough to be on a project called Ravencoin and to lead that project. And for people who aren't familiar with it, it's an asset tokenization project. The original base was Bitcoin, and then became added the ability to create your own tokens. Because of that, and being involved in that project, that kind of swept me into meeting lots and lots of people. It's probably the reason I'm here, is that with asset tokenization, I've been kind of involved in kind of the legal, or at least, I'm trying to help understand, why it's not super easy to do this, and learned a lot along the way from lawyers and stockbrokers and things like that. My background is a computer scientist. I have an MBA, and been doing computers and been an entrepreneur most of my life, since I was probably a kid. So anyway, that's why I'm here.
Fantastic. Kyle?
Hey everybody, my name is KyleSonlin. I have been in the industry for a long time, just like these folks. And specifically, I've spent maybe the last 5 years or so of my career working in the security token industry. After traveling the world, learning about blockchains and infrastructure, and speaking on countless panels and working with people around the world, I realized that the securities sector was really the biggest thing to be disrupted by blockchain technology, dealing with real world assets. And so we are the largest data analytics firm in the industry, tracking the markets, tracking what's going on in the space. That's STM.co, security token market, and love what I do.
Fantastic. Doug?
Sure, thanks. So DougPepe, I'm a commercial litigator in New York. I work at a firm called Cohen & Gresser, where I'm a partner. At Cohen & Gresser, we do, blockchain-wise, we do everything, runs the gamut from, regulatory investigative work, defending people who've been investigated, to, representing startups that are trying to, tokenize assets. We've got several startups that are in the space doing that, to, representing larger companies in the blockchain space. So that's the legal side. I also teach blockchain law and technology at GW Law School in DC. I also am on the Ravencoin Foundation with Tron. I'm a big fan and proponent of Ravencoin, and I've got several startups. One is called Mango Farm, IP Assets, and several other companies that tokenize real world assets on the Ravencoin blockchain.
Fantastic. So today, as I mentioned earlier, this session, Roundtable Asset Tokenization, with particular focus today on real estate side of things. But I guess in terms of what's happening in our industry, it's obviously widespread in terms of, when we have obviously some of these major exchanges like FTX as the latest one, it does obviously put a whole negative tone on our industry as a whole, regardless in terms of what assets and what have you. So I guess the first topic that I've put up, it's in terms of state of blockchain industry, given what's happened again in the last 6 months. We had Luna, we had Celsius, and now FTX, obviously being the second biggest exchange. And given, obviously, I've seen some of the papers in terms of the bankruptcy papers and some of the stuff that was going on, you just sort of shake your head. But that's we won't go into that because that's not what it's about. But obviously, it's brought a negative tone in terms of our industry. From probably just going around, probably from you, Doug, obviously, given you're a practicing lawyer and also obviously the co-founder of Mango Farm Wallets, Mango Farm in terms of Ravencoin wallet there. I guess in terms of, as an industry, that's sort of this negative tone. Obviously, people start thinking about in terms of where they hold their digital assets, right? In terms of obviously some of the exchanges and given what's happened with FTX, it puts a massive question mark in terms of where people are holding their assets. Probably from your perspective, what are you seeing from your perspective as a practicing lawyer, and more so in terms of having the Mango Farm wallet?
Yeah, I mean, it's a good question. Without getting into any particular, any one of the particular things that have occurred this year in the blockchain space, I mean, just to generalize, sort of where I see the fault lines here. I mean, there's self-custody, and there's sort of the peer-to-peer transaction, the decentralized networks, peer-to-peer transactions that Satoshi Nakamoto invented, right? So that's the essence of what Bitcoin is. It's the essence of what blockchains like Ravencoin are all about. Peer-to-peer trades, self-custody, you hold your own keys. When you extrapolate from that, when you sort of go beyond that and you get into situations where the assets themselves, the things that ride on chain, are being held in custody, and when they're being rehypothecated, reused, turned into IOUs that trade between different companies, that's where you get into issues that, so they're not blockchain specific issues. They're issues that relate to finance generally, right? The mortgages were the thing that brought down the financial institutions in 2008. Blockchain is having issues now where companies are investing in blockchain, dealing with blockchain assets, but they're dealing with them sort of at that second level, at that sort of finance level. There's good and bad to all of it, right? But I sort of bring myself back when asked this question and think, so what is the thing that Satoshi really wanted to? What's the problem Satoshi wanted to solve? And the essence of that problem was to allow people to transact in something. In the context of Bitcoin, it's sort of pure raw value, right? It's a little string of hex code that we all attribute value to. In the context of Ravencoin, it's sort of a reference to a real world asset, or a reference to the legal rights relating to a real world asset. But if you're trading that on a peer-to-peer basis, on the system, on the rails of the blockchain, with self-custody, none of these issues happen. These issues have nothing to do with blockchain. They have to do with companies that happen to be using blockchain to do sort of the financial stuff that Satoshi, in fact, designed Bitcoin to prevent. Bitcoin was designed to prevent the need for trusted third parties in the middle of our transactions. And here we are. We've given our transactions up to trusted third parties. So that's sort of my technical, not legal, technical sort of approach to this.
That's great. That's great. And Klaus, I guess from your perspective, you're talking to property developers, and obviously, given your business, as we are clients of yours, in terms of what we're doing in Australia. And I guess when you're going around, tell us about in terms of has it been a negative tone from property developers looking at tokenizing real estate on the blockchain through you guys?
Yeah, it's a good question, and we bring up that question on every week's sales call. I would say sales status call in the company, and we don't see a significant effect yet. We've seen a few clients that have sort of been postponing projects or postponing payment, but it's insignificant at this stage, I would say, and it seems like demand has remained the same. I would also say that even though there is a crypto crisis at this stage, that should, and it reflects poorly on all of us, I would say, if you are within the space and you know what's going on, you will understand that it has nothing to do with blockchain or tokenization in itself, and it should, in fact, I would say, increase the demand for what we're doing in the tokenization space, because it's much more secure. and it's regulated and it's compliant. So hopefully we will see increased demand from companies who are already looking at doing tokenization. I would also say something that we've been discussing a lot, and we also hear from real estate clients, is that even though real estate itself is now dropping in value globally, right? There should be an increased demand for what tokenization can bring, exactly liquidity, because making your asset liquid increases the price and makes it more attractive for investors. So I would say tokenization should hopefully become even more, I would say, relevant and valuable tool throughout the crisis.
Yeah, I agree. And you, Tron, in terms of obviously, being the lead developer for the Ravencoin and co-founder Ravencoin blockchain, in terms of people that are sort of planning out new projects on the Ravencoin blockchain, what are you seeing at the cold front? People are obviously talking to, planning things out. What are you seeing there? Has been much of an impact given what's happening?
So I don't see that much as far as so one of the things that Ravencoin doesn't require permission, so no one has to come and ask to use it. And so if someone wants to tokenize something, they can do that completely they don't have to talk to anybody. It's just, Ravencoin's just code. But I did want to mention, one of the things that, prior to Ravencoin, I was working with T0. I was employee 4 or 5 of T0. And one of the things that, ironically, that it was intended to do, and I can't speak for it today because it's largely silent, but at the time, and its original founding was to solve this problem of rehypothecation of shares of things, right? So specifically in stocks, and Patrick Byrne, kind of famously was kind of a victim of people naked short selling, meaning borrowing shares that didn't exist, and so it was intended to solve that problem. And the tagline was the trade is the settlement. So rather than settling days later and potentially hypothecating while the shares are waiting to trade, to actually make that settlement, which it happens today in 2 days. It happened in 3 days at the time we were doing it. So there was kind of monkey business in the middle of that. Anyway, that was kind of the original genesis of why I was at Overstock, was actually trying to solve that problem, and then Ravencoin kind of came at least out of the brain trust of one of the individuals that was kind of helping with that. If things are trading on chain, that this can't really happen when you put it into a trusted entity, and that trusted entity kind of violates that trust. And then you have this ability to think that you have it, and so you really have 2 copies. You have one copy of the token that's in a database, and one copy that's on chain. If stuff stays on chain, that can't happen. Hopefully, we get to the point where we have entities with enough integrity that doesn't happen.
That's right. And Kyle, from your perspective, obviously you play, especially with SDM markets, playing a key role in terms of educating and obviously with the security tokens advisors, in terms of advising clients. What are you seeing at the cold front, given what's been happening?
Yeah, it's interesting because we've actually seen a pretty significant uptick in actual asset managers looking to work with the technology. A lot of them seem to be relatively unfazed by the general crypto calamity, if you want to call it that, just because I think that a lot of our education has actually been working. And so most of our client base is high net worth individuals that are still looking to learn about the industry. I think that the good thing about how quickly this whole thing came and went is that most of in my experience, a lot of our network that was still trying to wrap their head around the technology, around the developments, still are trying to do that. And so, for us, we've been through multiple bear markets now, and I think that's a huge advantage for our business because of the fact that you just got to keep building. And in my perspective, bear markets sometimes are actually easier than in the bull case, because I cannot tell you, Luis, how many times we've had either investors or clients or anyone in between asking me, why aren't you doing NFTs? or why aren't you doing crypto? And it's so annoying because I like the fact that they want to learn, and we take the time to explain why non-fungibility is very inefficient for a liquid market. We take a ton of time to explain why you need to follow securities laws. We take a ton of time to explain the important differences from a legal structure between these different types of assets, from a investment structure, from a due diligence perspective. There are countless reasons why these assets are very different, and they almost all start with the fact that real world assets need to follow real world laws, and cryptocurrency does not. And the reason why that's effective is in the bear case. I've talked about this many times, right? It doesn't take anything. You don't need to have an actual asset behind your crypto to see it go up during a bull market. The problem is when it goes down. And when these assets that have no backing behind them, no price anchor, or no reason to stop the negative momentum, begin to build up that sell pressure, they're down 10, 20, 30%. No one's buying. No one wants to buy this thing, especially once it's down 30, 40%, because there's nothing behind it. And perhaps some of the cryptocurrencies, a small portion, might represent a commodity to some degree. Perhaps you want to own a commodity for a specific reason. But even if we look at public markets, most people that are bullish on hardware technology, on actual microchips, most of those people are not buying silicon. They are not buying the cobalt. They are not buying gold. They are not buying the hardware, copper. They are not buying the commodities behind these assets. They're buying NVIDIA, or they're buying AMD, or they're buying shares of companies that turn those commodities into something. And so even in the best case scenario, for my opinion, that crypto is a commodity and not a security, and certainly not something else. I think that most of crypto would prefer that the CFTC in the US looks at these assets, that a lot of these things are treated as commodities. Even in that case, we don't see the commodities markets booming with retail interest. For the most part, commodities markets are famous for being short squeezed. That's their biggest, the silver short squeeze, people fleeing into gold during times of calamity. These are not asset classes that the average person decides to get exposure to traditionally. And so I think that because of that, it really helps put into perspective what we're dealing with here. The real asset markets, real estate, debt, equities are hundreds of trillions of dollars, and it works very well. You need accountability for these assets. You need the person that's fundraising for these assets to follow existing rules that are in place, not because of the fact that the SEC, which ends up leading the example for everyone around the world, has always enforced by regulation, by enforcement. A lot of these rules are in place because someone was a bad actor, someone did something illegal, or someone did something that should be illegal, and we all decided they need to follow that. We have the GAAP, the generally accounting principles, or whatever the generally accepted accounting principles, for a reason, right? We have Dodd-Frank for a reason. 2008 was a disaster. You've got the crisis of the 30s. You've got the crisis later in the years. There's a reason why we have these rules and regulations, and it's to put things in place to protect investors. And these types of assets do not protect investors because there's no underlying asset. There's no claim to anything that's being created. And so I think that we feel like we just get to tell our clients, hey, look, we told you so. We've been saying this for 5-6 years now, that these things are not working. We say it during bear markets. We say it during bull markets. So we haven't seen a particularly significant decline. My traffic's been up. On my website, our client base has been up, our revenues are strong. So we've seen a pretty significant bump. It tends to be during bear markets in the initial run, at least, because I think everybody says, oh, wow, wait, this maybe isn't the answer. We need to find something that is. And we've always been there, and we always will be.
That's some great points there, Kyle. And just to add to that, I mean, in terms of, I think this time around, given what's happened, there's been, obviously, compared to other cycles, there's never been this level of debt leverage as before. If you go back to 2018, we didn't have DeFi back then like we have today. And I guess with any traditional markets where if we go back to the global financial crisis and what happened there, we all know what happened there in terms of over leverage and so forth. And again, we happen now, it's in our industry, it's happening now as to why people, these over leveraged positions that people are taking, and fraudulently, some of them, obviously.
It's ridiculous.
And again, and this is what I think, I think sometimes, unfortunately, there's a lot of people that have been hurt, but sometimes you need these moments to weed out the cowboys, in our industry. As much as
I mean, it doesn't take a genius to realize that this is synthetic debt. I don't understand how everybody was able to express such extreme measures of cognitive dissonance to say, I was looking at the FTX guy, SBF, just came out yesterday, I think, and sent a letter to his whole employee base where he just keeps digging himself in bigger holes. He was trying to explain how they got into their position, citing 60 billion in asset value that they were taking a leveraged position on. How did you possibly ever think that the assets that you held were worth 60 billion? There's a reason why on my platform, if anybody's gone to stm.co, we have a new site, fully new revamp coming out in about a week and a half, which we're super excited about. But if you've been on our site for the last 4 years, you'll see that we have a market cap column on our site, and this tracks market cap. There is a difference between market cap and valuation. Okay. Market cap is the circulating supply. If you sell 10% of your company worth $100, the market cap would be $10. It would be 10% of the company. So you've got valuation, which would be that $100, what the full thing's worth. And you've got market cap, which would be how much is circulating, how much have you sold to other people. And the reason we make such an important distinction there is because the fully diluted supply, the valuation, is not, you cannot use the circulating price. If you only sell 10% to the market, we cannot assume that the 90% that is not sold to the market is going to sell at the exact same price, right? Supply and demand. If we found appropriate demand for 10%, if you flood it with 90% more, that price is going to go down pretty significantly because there's no additional buy pressure. And then you're selling 9 times more newly onto the market. And so all of these guys take these super low float assets. They created Serum out of their own lab. They created the OxyMaps company. They created FTT. These are synthetic assets representing basically nothing that they're projecting a valuation on based off of a very low float and then fundraising on that huge overly inflated valuation and then give this shocked face when the asset prices come down. Like, these are cryptocurrencies. We see volatility all the time. The fact that you had no measure of protecting your debt liabilities in the event that the market goes up or down, even if they were rational actors, and even if there was no foul play, how could you not factor in the realities of the fact that crypto markets can go up and down wildly, right? Like this happens all the time. We see it every year. It seems like crypto comes down by 50%. So if you're shocked by that, if you were unprepared by a market drawdown, especially in what economic climate seems like one that would facilitate a market drawdown, like, it's ridiculous. And then on top of that, again, because of the fact that they have no debt liabilities, they've taken none of their cash and put that in position of maintenance. They've taken none of their cash and put that into liquidity for the underlying creditors. It's absolutely ridiculous to me. I hope this changes because I don't understand how you can fool yourself into thinking that is a logical or rightly structured product. I just don't have any understanding. So that's why, again, to the point of earlier, we have fractional reserve ratios for banks. These are numbers this is a percentage that banks have to keep in liquid assets to account for if someone wants to pull out their cash. It doesn't seem unreasonable to me that we would put fractional reserve requirements in for custody agents in crypto. If people are going to give you your assets, you have to maintain a pretty high standard of that in liquid collateral. Okay, sure, it's going to be worse for your business model. You're going to make less money. That's what you decided to get into. Your business model's commoditized. It is what it is. You're going to have to find other ways of creating value. or debt maintenance, right? If you're going to take on these huge debt positions, billions of dollars, you look at Genesis, BlockFi, Celsius, Voyager, FTX, obviously, and think about, I don't know, at least a dozen more that are much smaller that didn't get reported on because of the fact that they were just smaller fish, or they don't want to, they're successfully figuring out how to patch the ship at this point. How is it possible that they can take out these hundreds of millions on totally illiquid, totally volatile positions and claim that this is high rated debt is beyond me. So to your point, Luis, I think that leverage has caused an unequivocal collapse in this market that could have been avoided. I mean, leverage just amplifies these mistakes by a significant margin. And hopefully these players learn their lesson. I know that they won't, which means that we just, unfortunately for crypto, we need more regulation, and they don't want that because they don't want more control, but they can't help themselves. They just cannot, no player can help themselves. And the ones that are doing right, it's unfortunate because they've been pressured by either their investors, by their clients to bring their prices down, to offer better rates, to stay competitive in the market. So they've had to do the same thing. And it's a peer pressure style of scenario where when one person takes that outstanding risk, they convince themselves it's good to go. And then the other players have to follow suit in order to stay competitive. And that's an exact scenario where regulation just has to come into play to prevent these guys from doing that, because clearly they can't regulate themselves.
I totally agree. Some good points there. Some great points. Just to round off this, the first topic here. Again, we've all started businesses, right, across over the years in different forms, and I'm sure us many businesses. And I guess in terms of what I encourage people is basically, when you start out and building a strategic plan around your 5-year vision, and you plan things out, you got to stay true to that plan in terms of your strategic vision, regardless what the markets do. So again, if it comes to my colleagues who are tokenizing real estate in particular, if you planned it out, stay true to it, because the markets will go up and down, but it doesn't affect real estate tokenization from that perspective. So again, just a message out to my colleagues that they might be thinking about maybe just putting things on pause. At the end of the day, there's never a right time or never a wrong time. The right time is now to keep basically on that journey that you set out over the next 5 years in particular in terms of what you're doing. So that just sort of, could have passed on, like I said, whether it's, real estate tokenization or any business in general. You just got to stay true to that 5-year vision in terms of what you put in place, and stay true to the core of those objectives and goals, what's been laid out. So regardless in terms of the negativity at the moment, just get on with things and just keep building. And but we're moving on to the second discussion point in terms of, which sort of ties a little bit in terms of the previous one. Obviously, what are the barriers in terms of attracting mainstream to our industry? And obviously, all the stuff that's happened doesn't help us trying to attract the everyday person that's never heard about blockchain. All they think the blockchain is Bitcoin is as far as their knowledge goes around in terms of our industry. And again, probably stay on you, Kyle, because obviously you play a key role with SDM markets and educating people to obviously bring people to our industry. Do you want to sort of talk to that in terms of the barriers that you see or experience in terms of bringing mainstream in?
Yeah. One that no one wants to talk about. Education is huge, I think, for sure. And that's the obvious one. We talk about that quite a bit. I think one of the biggest ones is user experience. I think the onboarding is really not great. And that holds a lot of people back. We conducted, our own crowdfund. We've seen brokers around the world that are working with offerings and issuers. We've seen a lot of the exchanges and marketplaces, and a lot of the tech isn't smooth, and it doesn't either function the way that you're expecting for a alternative asset, or for something that compares or is a substitute good for what the public market provides, or the information, the diligence procedures just aren't as clear, or any of these different things. It's kind of wonky, and that's something that hopefully we'll continue to build. But I think that the industry as a whole needs to continue to work on making things smooth and easy and what's familiar for investors. It needs to look and feel kind of exactly like what they're expecting it to look and feel like. And I don't think that having to identify using KYC or AML is necessarily a burden for the average investor. They all have to do it for opening their stock trading account or for opening a bank account. The difference is that it's so much easier to do it using the Robinhood app than it is using any of the applications that we have in our ecosystem. And that's not to say that everyone's not trying to do that. And I know that everyone's giving their best shot and it's not easy, right? There's a reason why Silicon Valley pumps billions of dollars into UX, UI designers and into the technology and into developers. It's to make it easier and more frictionless. But I actually think that it's a pretty underrated reason why it's hurting adoption, is that somebody opens up any of these different solutions and it's just unfamiliar, and any one of those friction points causes drop off. Any one of those friction points causes someone not to participate in these markets. So I think that that's a big one that people don't talk about. As we mentioned, education is huge, but really what it comes down to, retail won't spend a ton of time learning and doing diligence on something until there is time pressure, until there is a reason that they need to get in now. And so, it's partially psychology, but it's also partially the fact that we need to focus on continuing to onboard great assets that people want to invest in. I think that debt products, for example, no one really wants to invest in debt products. So maybe that'll attract institutions. But if we bring on hundreds of millions or billions of dollars of debt on chain, it's just not going to be very attractive for the average person. How many people do you know in your network that are buying corporate debt, for example, right? Not many, I would imagine. Even at Coinbase's 15% corporate debt, I guess a lot of people aren't sucking that up, even though I think that to be a pretty interesting investment. And so, I think that we need to find interesting companies because people relate with companies, right? Things that they use. We need to find interesting exotic assets that people want, and then find ways to target them to drive value. So there's certainly a lot of reasons. I think that everyone on this panel is going to have really great answers to how we can drive more traffic. I think consistency is an underrated part as well. We, as a security token group and by proxy, our different subsidiaries, have built a lot of trust because we are the same message from 5 years ago as we are today around preaching the value of securities, preaching the value of this market, and focusing on driving adoption. And we say a lot, consistency builds trust. And so building trust in this market is going to be really important. You look at Coinbase. Coinbase launched in 2012, and they didn't see any significant retail adoption until 2017, most likely, right? So that's a 5-year span that it took them to build their infrastructure, to focus on that friction and reducing friction, as we mentioned, focus on education. And then they had an asset, Bitcoin, that people really wanted to invest in. So they were able to capture that due to their longevity in the industry. So I think that it's a combination of those three things. It's onboarding and making that process smooth. It's educating and building trust through consistency. And then, of course, it's focusing on things that people actually want to learn, to use, to invest in, and to participate with. Those three are, I think, the core tenets of driving adoption over time.
That's great. That's great, Kyle. And Sean, from your perspective, what do you see in terms of the major barriers in bringing mainstream in?
Well, I think this is a completely new technology that allows things to happen that have never happened before. And one of those things is bringing this, being able to take an asset like real estate and make chunks that are bite-sized, right? So you could buy $100 worth instead of like a whole building, right? There's kind of no way to say, I want 2% of that kind of thing, and I want the exposure to it, but I can't afford an entire building and to manage it and all of those kind of things. So basically, at the end of the day, the technology is a ledger, and a ledger runs itself, right? I mean, it's automatic, and so you now have this ability to chop stuff up. And the management of a ledger like that's kind of like potentially trading, and potentially in multiple venues, which I think is another, other direction I think we need to get to. But the ability for a ledger to do that automatically and take the the management and maintenance, because it would be impossible really for like a lawyer's office to say, hey, I want to trade this with Bob, and and we're changing on the spreadsheet, and yeah, my name's really Bob, and here's that kind of thing, whereas the ledger does that for you automatically. So there's a new capability that exists. It hasn't existed for more than about 10 years, and that technology allows something to happen that has never happened before. A little tricky with the legal thing, just because they haven't kind of sorted out all the details. But I think, and then the other thing that I think has happened is, which is good, is the rules have actually changed. I mean, we were looking in 2015, actually, 2015 at the Jobs Act of 2012, and took them 3 years to kind of figure something out. And even now, those things have been modified. Really, in the last year, two things have been modified. The credit investor rules now are allowed. You can do that via education and not just a wealth test. That's helpful. But the Reg CF rules, which allow retail investors, have been modified to allow a higher amount, right, from 1 million to 5 million. And these are all U.S. things, so those may not, they only apply if you're a U.S. person. But a lot of those things were actually holding things back, and those have been, I'm not going to say fixed, but definitely improved really over the last couple of years. I mean, literally kind of during COVID. And so I think those things combined with crypto really make for a new product offering that's kind of never existed in kind of ever.
Mm-hmm. That's great. And Klaus, from your perspective, in terms of obviously bringing mainstream in, what do you think some of the barriers that you're finding from your clients, or whether from your clients in terms of the token buyers? What are you seeing, Klaus?
We see, I very much agree with Kyle actually on the usability and the user friendliness of the systems that we have in the industry. Even being a solution provider myself, I think the focus has been the last 4 years on getting the basic pieces in place and learning the use case and sort of making the basic workflows function right. And now I think the focus in the industry, certainly for us, is shifting more to UI and UX. And I think we'll see a lot of improvements in that field over the next few months. But I think it's taken a long time to get the ecosystem in place. And I think it's the user friendliness of the solutions are actually suffering due to that. It's difficult, I would say, as a solution provider to find payment service providers who want to work with securities and tokens. That's a difficult combination, I have to say. So helping the majority of real estate developers who actually prefer to take fiat payment rather than crypto payment is difficult, I would say, just for one thing. And those that want to take crypto payment, they have to educate their users to understand how to use MetaMask and other wallets. It's not easy either. So we are partly to blame, but I think the overall ecosystem also needs to mature, and it's happening right as we speak. So that's, I think, is definitely one of the primary reasons that we don't see more adoption right now. We see enough adoption, but it's a barrier towards more adoption than we get. Otherwise, I would say regulations, global regulations. In the US, it's not a problem, right? But if you are in Europe or in Asia, I think it's a major problem, right? Because most regulators, I think in Europe, you can tokenize in maybe 50% of the countries. In Asia, it's less than that. It's maybe 25%. In the remaining countries, tokenization hasn't been sort of clarified by the regulator, and you are forced to be in a sandbox process. The first one that gets through the sandbox process will clarify for everyone else. But even in the case that happens, there can still be sort of major showstoppers for tokenization to function, such as the requirement to notarize a share transfer, for instance, in some countries. Other countries, you may have something like a stamp duty tax that you need to pay upon a transfer or trade of a share, and you may need to be registered with the in some kind of national register to be able to do that. So there can be sort of showstoppers that prevents tokenization from being implemented in certain countries due to things like that. And then I would say also generally, I think it also comes down to education and retail adoption and developing the buy side for what we're doing here. So we have a lot of clients tokenizing assets, and So the sell side is extremely interested in what we're doing, but the buy side not so much yet. And that's I think what we need to work together on as an industry to educate and to try to develop distribution channels and get some great assets tokenized.
Absolutely, absolutely. And you, Doug, in terms of what are you seeing some of the major barriers to bring mainstream in?
Yeah, sure. First of all, I agree with everything that was said, especially what Kyle said about UI. But the way I think about this is, I mean, you can have the best UI on the planet for a product that's useless to people, and if they don't know why they're using the product, if it doesn't hit home to them in their pocketbook or in their sort of utility function in their head, they won't use it. Right? You can have, a great UI for, McDonald's tokens, and nobody's gonna use it. So, I mean, the way I think about it, we have to show people in a concrete way what the benefits are of the thing that they're using. And I'll give you an example in the real estate context, because, Louis, you're into real estate. I mean, I don't think most people actually, one of the least user-friendly systems in financial transactions today is the real estate deed transfer system, right? It's archaic. It was invented at a time when people plucked feathers out of, birds' backsides to write down documents. They get stored in a county clerk's book with it used to be a wax seal, now it's a big stamp, and it takes a month to do, right? And every time you transact in real estate, you have to hire a lawyer. The lawyer has to search the title. I'm not talking about real estate fractionalization and securitization. I'm talking about real estate. Right? You have to hire a lawyer. That costs you $1,000, $1,500. The lawyer has to search the title. They never do. Right? Nobody searches title back to 1789 in the United States of America for a simple, homeowner property transfer. So what do? Because the lawyers don't actually do a proper title search. They hire a title company. The title company searches, sort of the past couple of deed transfers, and then, stamps and says, well, if our title search is bad, we'll pay out if there's any damage, right? So you get this thing called a title policy. So you paid $1,500 for a lawyer to do this sort of transaction. And the title company charges, on average in America, about $850 to the homeowner and about $250 to the mortgage company, right? So you've got over $1,000 in transaction costs there. So you got $2,500, $2,700 in transaction costs, right? Blockchain solves that problem. You don't need title insurance from the moment of initial provenance, from the minute that good title is put on a blockchain. From that day forward, you do not need title insurance for every transaction. The title is on the blockchain. So, think about the deadweight loss to the system that occurs and to every homeowner every time, right? You don't even see it. It's sort of baked into your mortgage. It's part of the calculation. You don't see how much money we're actually paying. $2,700 for every real estate transfer in every parcel of real estate in the United States of America, right? You need to show people that, and then you need to show them a system that eliminates it. You buy title insurance once, the title company insures it for all time. It costs, say, $3,000 the time you do the initial provenance, and then that's it. From that day forward, title is established. Now, the interesting thing for me is the regulatory, which Klaus was talking about. You can't do that in most counties for real estate in the United States of America. You have to use that antiquated, sort of stamp it in the book system. And so it's sort of a two-pronged problem, right? You got the UI, you got the UX, you got all that. But then you have sort of what is the use case? What is the real utility? How is it hitting people's pocketbooks so that they really desire to use this product? Trust me, I don't care what your UI looks like. If I'm saving $2,700, I'm going to use, Command C, Command V to get it done. But regulatory is critical. It's almost impossible to do a true sort of, in the nature of what Tron was talking about with Patrick Byrne, tracking mechanism for securities on the blockchain today. I mean, there are a couple of companies that are trying it. A lot of them have tracking mechanisms and on the blockchain and actually use a transfer agent for the actual settlement because of the regulatory sphere. So you can't really solve the Dole Foods problem directly on blockchain right now with blockchain because of regulation. Same thing with real estate. We need sort of forward-thinking counties like Teton County, Wyoming, who will put out these pilot programs to allow people to actually transact in real estate interests on the blockchain. It's sort of a dual approach. First, get people to want the product, and then second, get regulators and sort of county, even at the county clerk level, to understand why there are real benefits to having the product work this way, and then, sort of transmogrify the entire system. It's going to take a long time. We're so early. Our property system has existed since the 1700s in America, and before that in England, and it dates back to when people used to hold up, little bales of wheat to their lord and master. So we're talking epical shifts here, not sort of what's going to happen this year and why aren't people using my product? It's really, we're all in this to try to transform a world in which, if you look at the major buildings in every city, the ones with the marble and the brick and the solid looking buildings, right? Odds are those are one of two things. They're either a government or they're a trusted third party that's been skimming a percentage off of everybody's transactions for what they do. Now, the former is sort of a political issue. The latter is something that we can fix because Satoshi gave us the solution to fix it. It's going to take time. It's going to take effort. Companies are going to rise. They're going to fall. A lot of companies are going to fail. You're going to see a lot of scams. You're going to see a lot of successes. But at the end of the day, at the end of the process, what we're looking for is a system where when it adds value, people will trade assets with each other without a trusted intermediary. It's that simple. And there's real value to that. We just need to show people in a concrete, material, financial way, like in the real estate example, why that adds value to their lives. So that's my answer.
I totally agree, and totally agree with all points made. When you talk about, Kyle, about the user interface and the ease of use of the platform, obviously our platform was created by DigiShares, and again, we're always trying to sort of think in terms of how do we make things easy for people. Obviously, with Klaus and his team's obviously involvement in terms of what we present in terms of tokenized real estate. Probably just to share just an example, like the last property we launched 2 weeks ago, the Brick Dolphin property. We launched that on the Ravencoin blockchain, and basically what we try to do is try to sort of cater for the people coming in from mainstream to make it easy as if they're just subscribing to a Web 2 platform where they just put in their details, but at the same time cater for the people who've been around blockchain for a long time. They want to actually hold their own tokens in their own wallet. So we actually decided to give people the choice in terms of we can custody those Brick Dolphin tokens on our platform for them on their behalf. So for those new people coming in who don't know how to use a decentralized wallet, that we could custody those for them. And the second option is they can take those Brick Dolphins to their own wallets, their centralized wallets. And some have, like we have personally, in terms of like myself personally, I use the Mango Farm wallet, not because Doug is here, but it's just an easy wallet to use. And that's where I'm keeping my personal, in terms of Brick Dolphins and my other NFT art pieces that we own as part of these properties as well at the same time. So again, it's providing that flexibility from people new coming into our industry, as well as catering for people who've been around for a long time who are comfortable using decentralized wallet. So providing choices to people, and I guess in terms of our platform, we try to give that ease of use and options in terms of depending on their experience of use around blockchain. So, but I will share something with you. And actually, our Brick Q&A this morning, the topic that I spoke about was about KYC and AML, and just to give you some feedback in terms of probably around since the last two properties that we've launched, we probably had around 30 people that they get to the point where they put their details, their email, then obviously verify, making sure that they can go to the next stage in terms of entering their personal details and doing their KYC and AML, uploading their proof of ID and address. We probably had 30 people that basically don't go any further. And we wanted to sort of go deep in understanding as to why. And I guess we've got still a lot of people that don't want to show their identity in terms of when they're actually holding, obviously in tokenized real estate, we have to do AML and KYC. That's just the compliance. That's the compliance. And because again, at the end of the day, we're trying to go to secondary market exchanges, and to go to a secondary market exchange, that's just a requirement. So it's like it's a catch-22. Like, at the end of the day, you want liquidity, but you don't want to give details or any personal ID. So it's that situation that we got at the moment where we've probably around 30 people that just don't go any further. They don't want to give their ID, and we're just fucking. We fully respect that. That's okay. But again, it's just understanding people. At the end of the day, if you want to have access to tokenized real estate, that's just one of the compliance things that has to be done in terms of KYC and AML. providing those identity documents. And because at the end of the day, going to a secondary market, that's where you're going to get liquidity. And so just to sort of share in terms of what's happening at the Col from our perspective and our experiences, especially dealing with KYC and AML, in terms of what people's views are. And I've had many conversations with people, and as I said to them, I fully respect the decision. That's, whatever reasons, we fully respect those reasons that you don't want to do KYC and AML. But again, from us, we make no exceptions to anybody. That's our rules, that's our compliance, and we'll live and die by our compliance that we have in place. And probably just on that point you made, Klaus, in terms of payment, in terms of ways to pay using crypto, again, that's probably something that's a big gap in the market, allowing people to use a merge facility to pay for property tokens. I think we've had a look at 7 merge facilities and none tick the boxes, either because they're too high fees or whatever, they're too complex in terms of that user interface to be able to people use those merge facilities. So yeah, I think there is a barrier, because again, we're trying to make things as easy as possible, and the more options you got, the better it is, because you don't want those sticky points to make people easy to come in terms of what we're doing. So so I think there's a gap in the market there in terms when it comes to paying a merge that allows ease of payment using cryptos. So if you know some, let me know, because we're on to our 7th one now that just doesn't tick the boxes. But so let's just share those barriers, and there's some really great points to hear on those barriers. Just moving on to the 3rd topic there, where in terms of, and I think Kyle, you sort of touched on it, in terms of people who are obviously heavily investing in cryptos, they're very sort of narrow-minded, invest in the crypto market. And I guess this topic is, do you think tokenized real estate for the everyday crypto investor is just too long-term and too conservative in terms of what they do? Again, we're not saying that's real estate, tokenized real estate is the only investment that you must invest in. All we're saying, I think people should have a balanced approach. And again, this is not financial advice from anybody else. We're just providing general information in terms of our thoughts about tokenized real estate, how it plays in the whole game and things. And I guess to you, Kyle, first, again, obviously you've built the course in terms of teaching people about tokenized real estate. Obviously you saw a gap in the market in terms from that formality, because none of the universities or any formal colleges out there are doing it. And obviously this guy saw a gap in the market there in teaching what tokenized real estate is all about. Do you want to just sort of speak to that in terms of crypto investors, whether that's something from here or just in general in terms of the formal education in terms of what you're doing?
Sure. Yeah, I think that an important piece for us has been helping build self-education tools, so that those that are looking to get into the industry, or looking to learn, or looking to empower themselves, can both get access to the content that they need, as well as following their own timeline and their own pace, especially because a lot of the people that are still looking to get into this industry are probably asset owners themselves, whether they own real estate, whether they own a brokerage, whether they're looking to get involved on the real estate side due to their relationships. They likely are trying to purchase this course, looking to trying to learn in order to apply it to their own business model, their own expertise, their own industry. And so creating self-paced content that is still incredibly high value, is official, and gives you a great foundation. We've been able to partner with some amazing people and companies to drive content. That's been really important for us from an academic side. There's only so many videos and interviews that you can do. And at some point, you need to actually answer a lot of the very tough, hard-hitting questions that are needed to actually figure out, okay, how are we going to use this technology? How does blockchain change real estate investing? How does a title get affected with this underlying tokenization piece and the fractionalized shares and everything going on? Somebody needs to answer those questions legitimately, and that's what we tried to answer with our 10-hour course.
That's fantastic. And Klaus, in terms of from what you're seeing, obviously crypto investors, they're looking for obviously a quick return. We're all collective in some way investing in cryptos, but I guess there's a lot of crypto investors that are looking for that quick returns. And obviously real estate's not going to give that quick returns. It's a long-term thing, right? As we know. what do you think, Klaus, from that perspective, in terms of crypto investors? Are they looking to invest in real estate, or they're just not at all?
Good question. Good question. We wouldn't know, actually, being a technology provider. But I think that the hope is that they will be interested, at least indirectly, sort of interacting with, I would say, collateralized real estate, for instance, for DeFi lending, and providing liquidity for real estate trading and stuff like that. So indirectly, they can help provide liquidity for the real estate ecosystem, even if they don't directly invest. But they can help facilitate liquidity and lending and so on for maybe non-crypto investors, normal non-crypto investors that are interested in real estate, that can access, hopefully, this market in an easy way in the future.
That's right. And Doug, in terms of from your perspective around the topic, I mean, obviously you're coming across all sorts in terms of crypto investors. You're obviously doing, in terms of people and doing their projects and so forth. Well, what's your opinion on that in terms of are they looking to invest in tokenized real estate, or?
Well, so yeah, I mean, look, I love that, Kyle. I didn't know that you did a 10-hour course on this. I'm going to watch your course. I teach this stuff at a law school, and one of the things I do in the class is I give the class an example. So here's a coffee cup. I don't know if you can see it. It says "Believe in yourself." It's my son's. He gave it to me. But I hold it up and I say, okay, you've been hired by a client to legally tokenize this on a blockchain and allow for the transfer of the ownership interest in this coffee cup. Go. How do you do it? Crickets. You know why? Contract law doesn't really cover it. Contract law governs the offer and acceptance, bargain for exchange between two people, but it doesn't relate to the rights of third parties, right? So if I, sort of have a contract in the chain of title, I have a contract with each person and each person and each person. A third party coming in and saying, I have an ownership interest in that coffee cup isn't dealt with by the contractual rights. So then you go to property law, right? So how does property law address this situation? It doesn't. There isn't any sort of governing body of property law on these issues, right? So it's what makes the space kind of neat for me as a lawyer, because there aren't sort of settled, there isn't a 100-year body of precedent on how you tokenize this coffee cup or fractionalize interest in this coffee cup. And then, you bring the graft. If you're going to fractionalize it, does that implicate securities laws? I mean, is it a security or is it sort of a fractional interest in the commodity? Interesting question. You get different states with different interpretations. You get sort of, the two different bodies of law, depending on whether you're in CFTC land or if you're in SEC land. You get different bodies of law depending upon which floor of the Treasury Department you're in. It could be property on the one hand, but for tax purposes, but for FinCEN purposes, it could be the equivalent of a monetary instrument. So like all of these different sort of bodies of law come together with a simple question of how do I tokenize and transfer this coffee cup? So I put this big Venn diagram on the screen for the class. It's got, multiple states, and it's got international regime, it's got FinCEN, it's got SEC, and it's got the CFTC, and I have a little black spot in the middle with an arrow that says, that's your client. In 2 years, for some of them, they're mostly 2Ls and 3Ls, second year and third year lawsuits. In 2 years, you're going to have a partner and a law firm come to you and say, I have a client wants to do X. How does that client do it? And you're there. What do you do? Again, silence. So I can't answer the question directly. Every single, and in many respects, this is part of the problem. Every single project requires a detailed legal analysis. Every single one. Two blockchain projects are two completely different things. Blockchain is a vehicle. Kyle and Tron have heard me say this. It's an empty vessel, right? You fill that vessel with legal rights and obligations, and it is the legal rights and obligations that determine what laws apply. Now, I had an idea for a solution to this. I proposed it to Wyoming. They got really close to actually doing it, and then they just sort of fizzled. But here's the concept. The concept is very straightforward. When you set up an LLC or you set up a corporation, you walk down to the Secretary of State, usually in Delaware, or you use their API, and you say, I would like to create this new legal fiction. It's a creature of law. It doesn't exist before I do this. And it's enabled by a statute called the Delaware General Corporation Law. And you say, give me this thing called a corporation. And as soon as you do that, and the Secretary of State gives you a stamp, this thing that didn't previously exist now exists. And it's got legal rights and it's got obligations associated with it. And it's got a whole body of law. It's called a corporation, right? You issue shares of that corporation and you can transact in them. But here's the kicker, or the important part. I'm a wonk, I'm a lawyer, right? Here's the important thing. No matter where you are in the world, if you have a dispute over those legal rights and that legal relationship between shareholders and the board of directors and a corporation, Delaware law governs that dispute. So Delaware, you can be suing in Zimbabwe as a matter of international law, Delaware law, it's called the Internal Affairs Doctrine. Delaware law governs that dispute. So it deals with the rights and obligations of shareholders, directors, corporations, and third parties. If we had a similar system, like if Wyoming created a vehicle for people to walk in and say, I have this coffee cup, and I would really like you to say, this coffee cup goes with this token, sort of certifying the initial creation of the token. And then, under a similar regime, creates a body of precedent around what the rights and obligations of people vis-a-vis that token are, then it would solve a lot of these sort of unsettled problems in the law as it relates to blockchain that nobody is talking about. Everybody talks about, I'm so tired of hearing about the Howey test. It's this much of law, okay? And it's easy. It's relatively easy. You can spot out something that is a security pretty much like that as a lawyer, as somebody who practiced in the space. But how do you tokenize? How do you actually tokenize a piece of property on the blockchain? How do I tokenize this coffee cup? There's nowhere to look. There's no answer. So I talk about this a lot because it's very practical, and I would like to see the lawyers in the space. It's really flashy to talk about this token or that token's security. I really like to see the lawyers in the space sort of come back down to roots and talk about sort of what is the essence of the thing we're doing here, and how the heck do we give people the tools to be able to do this stuff in a concrete way? Because you can tokenize everything from a piece of real estate to a fractional interest in a boat, to a timeshare interest in a jet, to a coffee cup, to a Beanie Baby, to an NFT. And the rules are different for every single one of them. So, to sort of wind this up, I feel very strongly about this. I think this is something that people need to talk about a lot more. And I'm super excited, Kyle, that you're talking about it. So
yes.
Flip me your 10
yeah,
hour.
Well, actually, it's a great time. It's a great time. We're actually doing a Black Friday sale right now, 50% off the course. STAcourse.com. I'm going to drop that in the chat. STAcourse.com. And the discount code is just Black Friday, one word. But it's really, really high quality. We partnered with Oasis Pro Markets and ATS here in the US. And it's a super, super high quality course. A bunch of our clients have been purchasing it. It's cheap. I think it's $500 with the 50% discount code. And so I'd highly recommend you jumping on that quickly, because it's only 50% off for this week for Black Friday. So would really, really recommend it because it's super high quality.
Right.
And if we can partner on it, I'd be happy to make intros to anybody on the STA team if there's ways to work together there as well.
Well, you should come. Tron guest lectures the mining module of my course. You should come guest lecture the property rights module.
Sounds like fun. I'd be happy to do that, or introduce you to anybody on the team if you like the course.
Great.
That's fantastic. And hopefully that's obviously with some of the crypto investors taking a breather from obviously trading on cryptos, maybe that could jump on that course, Kyle, and get an understanding what tokenized real estate's all about.
Now's the time. There's no better time to do it, just because this is our first and only that I'm aware of 50% off time. So definitely the time to jump in and really get the sauce.
Fantastic. Look, in terms of I think the hard thing, and for crypto investors, obviously being used to such in terms of making some quick gains on the crypto market. And I guess, just that people can understand these are long-term assets. Tokenized real estate are long-term assets that goes in value over time. I mean, if you have a look in terms of what's happened in New York, Doug, in your neck of the woods there, and have a look what property value has done over the years, over the last 100 years, obviously it's out of reach for the everyday person to buy a property in New York, right?
And releasing that liquidity is something that it's not something that's unknown to the experimentation of the New York legal market, right? I mean, we have co-ops, and fractionalized interest in real estate is not something that New York hasn't done. It's all over the place. But doing it, and there's actually a Supreme Court case on Co-op City, one of the biggest co-ops in New York. It's called the Foreman case, concluding that stock interests are not securities. Look, it's any asset, right? It's any asset where liquidity is locked up, bound up in a bundle. Property rights are a bundle.
Yeah.
And if you can sort of release portions of that bundle to release liquidity, just take a piece of art, right? I can't own a Picasso. I actually have a fake Picasso on my wall, but I don't have a real Picasso, right? I can't own a Picasso. Having a Picasso, right? I might want to have a fractional interest in a Picasso that allows me to view it once a week. That's a fractional ownership interest. I have the right to possess and view it for 1 hour a week. I might want to have an interest in the Picasso, sort of if it's sold in the future. I have tag along or drag along rights or whatever it may be. But any portion of any property interest can be sort of split off and released, and that the releasing of that liquidity and the transacting in that liquidity sort of brings a lot of benefits to the markets that currently don't exist, because we have the systems, we have legal systems to be able to fractionalize interest, we have legal systems to be able to unbind property rights, but we don't really have sort of the transaction mechanisms that blockchain brings, like the ability to do it, and it looks and feels like you're just trading in a in a stock, or it looks and feels like you're trading in a crypto. So, but yeah, New York is out of reach for many, many people. That's one of the reasons I live in New Jersey. I see my wonderful city out my window.
But I mean, obviously, like London, for example, where it sits, and I mean, even like here in Australia, in terms of where we're going. I mean, Sydney's always been our top of the end market, Melbourne, but obviously Brisbane with the Olympics in 2032, we go in the same way where property values are going, and we've had that experience, sort of 30% rise over the last 2 years in here in Brisbane, because of the issues around COVID, migration coming in, and so forth. So again, tokenized real estate is obviously the answer for the everyday person to access real estate is obviously the new frontier, as we call it. But yeah, look, it's actually. Kyle, I had her with your business partner on our show last week, and we were talking about what it's going to take to really put tokenized real estate on the map in terms of mainstream. And her made a good point about it in terms of, it'd be great to have a piece of iconic real estate to be tokenized by somebody on the blockchain. They'll create this massive awareness, whether it be a stadium, maybe FTX. I said maybe FTX is looking at the FTX arena as it was before, your Miami arena. Maybe that could be the new piece of real estate that could be tokenized to create the occasion.
We actually have an article on tokenized stadium rights written by Peter Gaffney, who actually did an article on that very topic a while back when it was the American Airlines arena, previously before it was FTX. Right now it is an open stadium naming rights, and it is something that you could absolutely, that's a contract, there's a cash flow and revenue stream there. It's absolutely something that somebody might want to participate in.
Actually, sorry,
I was going to say, Louis, how about even Yankee Stadium box seats, right? Create a secondary market for Yankee Stadium box seats by tokenizing those, and you'd see they would shoot up in value because the folks who get them and lock them in at an early price, it's something that you other folks want to get in on. So anyway, that's another example of two completely different types of property rights that arise out of a stadium that are worlds apart, but could equally be sort of broken out from the fee simple interest in the property.
Absolutely. Actually, it's on that stadium topic. At the moment, because I'm sort of involved in business leaders with our Brisbane Bulls, our NBL national basketball team here in Brisbane, and it's owned by a syndicate of Americans, Hollywood producers, an NBA owner, and what have you. And they actually want to build a stadium here for the team. So they own the team, they want to build a stadium. So my good mate, who's the CEO, Peter, I've actually started planting the seeds. Maybe the guys should be looking at in terms of tokenizing the stadium. So they built it, then tokenize, and actually have the team in the stadium owned by token holders. So I'm laying the seeds anyway, so it's still early. doing my bit. And I actually told I actually told him we've got a fantastic blockchain to do it on called the Ravencoin blockchain. So, so just planting those seeds anyway. But yeah, probably the last topic as we sort of wrap up. Last topic. We talk about in terms of reflecting back on the .com late 90s, the .com bubble that we had. We all experienced in one shape or form. We had it here. Obviously, in the US is much bigger in terms of some of those companies, and which obviously caused a reset moment, which weeded out some of the bad actors back then. And hey, Kyle, were you born? When were you born, Kyle? Were you
I'm in Philadelphia. I was born in Philadelphia, and I'm actually here now for Thanksgiving, and I'll be back in Miami by next week.
So you do remember the late 90s? You were at school?
I was around in the late 90s. Yes, I was.
So we saw what happened there, and obviously through that period, any public float that went to float that had a .com, we saw a lot of obviously blue sky and valuations around those floats that happened, and obviously some great companies came out of it in terms of Amazon, eBay, and Google that came out of that mix. But also there was some big failures as well, but that was all based valuations on blue sky. So I guess Tron, you involved in IT as a coder and so forth. No doubt you would have seen some of those players in those late 90s at .com.
Oh yeah, I was an investor in Pets.com, which is kind of a classic one that was doing a sock puppet on the Super Bowl ads. So yeah, that was a learning experience. So and I actually took some of that learning experience into crypto, which I think has saved me quite a bit.
Right. But again, obviously, that's a period that as I said, it's a reset moment. I think we're going through that reset moment now in terms of some of these companies, but it's great to hear some of those examples. Obviously, you experiencing it personally and what went on.
Yeah, no, I remember talking to we had investment advisor come into the company, yes. And they're, and I'm like, no, I'm betting everything on Oracle and just on all these different companies. And they're like, stuff could turn. It's like, I don't think so. This is definitely not going to ever change. And anyway, I was wrong. So again, another learning experience.
Right. Nice. What about you, Doug? You would have experienced.
I lived the dream. I lived the dream. I invested in a bunch of them too. So, look, I think it's a good thing, and this may be sort of contrarian, but I view the market, a free market, is sort of the great clearing mechanism. So, capital flows to a bunch of projects, right? The new thing comes up, and capital starts flowing in, and you get VCs and regular folks and everybody, they're putting their money in all this stuff. And then, it sort of inflates the whole thing, and then the whole thing crashes, and 1 or 2 or 3 world-changing technologies sort of arise. That's been a consistent pattern. And one of the issues that I have is when we try to get into that process before it happens, before that great clearing mechanism happens. I mean, moral hazard is a good thing. Companies failing it's a good thing. It means that people made bad investments. But other people make good investments, and those good investments will, over the long term, attract more and more and more and more capital. And it's when we try to get our the camel's nose under the tent and try to prevent things from happening, that's where I sort of have a problem with it. I do not know. I tend to think, and I believe this firmly, that if we applied the regulations that we apply to like your garden variety attempted startup in the city of New York, which is it's almost impossible to have a startup in New York under the BIT license, but even BIT license, and then all of the other sort of massive regulatory systems that we're imposing on these small startups right from the get-go. If we tried to do that to the .com companies, or even before that, to the computer companies, to the Steve Jobs, in the garage in Silicon Valley wouldn't exist. We would probably be at best using like a Unix-based system, where you do a timeshare type thing, maybe, because it would be sort of a computer science wonky type of space instead of a retail space. And I certainly wouldn't be talking to you guys on this TCP/IP protocol with our pretty pictures. So I'm worried. I worry a lot about that. Go ahead, Tron.
It just depends on who regulated it that way, right? I mean, we could be using all of this stuff from another country, right, where they didn't do that. So I mean, that's a risk we have now, where everything just shifts.
I agree. And look, the thing I worry about is how many. We need regulation, right? We don't want to have fraud in the space, but it's really easy to have a 2-sentence. I actually wrote it. It's on the Blockchain Law Alliance website. It's comprehensive blockchain legislation in one page, and it governs fraud in the blockchain space. But how many revolutionary products are we killing? We will never know the counterfactual world. Just like we'll never know the world where these regulations were applied to, because it's a third rail. You don't touch speech, and the internet was always sort of considered a speech venue. So regulation was just really never applied to it. It was, in the late 90s, Tron, you'll remember, and Klaus probably, it was a hands-off environment. People were adamant that you shouldn't touch the internet, and including regulators. That's what allowed it to thrive. That's why that's why I can have in 2 hours in New York or in 24 hours in New Jersey, I can have any product that I want in the world delivered to my doorstep, because Amazon arose out of that. It's why we can talk, because this Zoom product arose out of that. And I wonder, sort of, if we're throwing the baby out with the bathwater, with requiring KYC for people who are buying, tokenized interests in real estate projects in Australia. I don't know. I know that it's pretty expensive for you to do the KYC sort of compliance that you need to do, and I know that you're one of a billion people out there who are trying to do projects that are similar, and there's a significant cost to some of this stuff, and I think we need to just rationalize. I know eBay didn't have to do that. I don't have to KYC with eBay. So we just need to think about these things from a regulatory perspective, from a policymaker perspective. Like, what are we killing? And I think part of the problem is, at least to date, the past several years, the regulators, the policymakers, they pay lip service to the benefits of blockchain, but I don't really think they understand the benefits in their core. I think over time that'll change. But so I'm on a bit of a soapbox here. I just think it's sort of super important that we consider both sides of this equation. And when I see companies out there, it's a great thing, but when they're touting sort of our regulatory compliance, it's great, right? I think it's a good thing, but it's also sort of, we need to think about, what are we requiring them to comply with? I can buy a Visa card with $100 on it times 10 at CVS Pharmacy without any KYC, but I can't buy one, Ravencoin or Ethereum on a crypto exchange. Does that make sense? Or is the reason that exists is because Visa has better lobbyists than Ravencoin and Bitcoin? So, I'll just throw that out there for the group to discuss, or for, further consideration, but it's a balancing act. It's not just, sort of regulation is a good thing just because regulation is there. It may be killing a lot of innovative projects.
I mean, if you just on the point you made, if you go back to those early 90s, where I still remember 92, I was a young accountant starting out. And I can still remember, in terms of, obviously, internet was very early, and emails, and the government just hated emails in terms of privacy around emails. We couldn't send things over the email because the government didn't like it, because breach of privacy rules. And you have a look today, we hardly send any here, like, in terms of, I can't even remember a hard letter that I sent out. It's all over emails. And so and I'm sure you're the same, in terms of your respective businesses, in terms of sending hard email out. So again, we've come a long way.
Imagine if you had to produce a passport before you could use the email system back in 1997.
Yeah. Well, things like Zoom and Skype and all those kind of went up against the telecom thing at one point too. That was another kind of clash of, like, can we communicate over the internet? And I think the technology ultimately won, and I think eventually we'll hear too, but it's going to take a while it's clashing.
Yeah, absolutely. And Klaus, in terms of back in those late 90s, the .coms, what were your experiences back then, and any sort of personal experiences?
Yeah, I weren't an investor. At least I was young engineer working for Hewlett-Packard. Actually, Hewlett-Packard R&D in Silicon Valley. I had stock options for more than 200,000. That all went away during the .com crash. So it was also quite a bad time for me. But I got my eyes open for entrepreneurship. I would say I started my first company immediately after working for HP. So it led to me becoming an entrepreneur. At least I was just seeing all the wild innovation going on in the .com days, and people raising crazy amounts of money and spending it equally fast. Right, it was really exciting to me. So I got into the space.
Nice. What about you, Kyle? Late 90s, what those .coms? Were you investing in any of those? Any sort of personal experiences?
I was not super active investing at that time, but I think that it's interesting to watch because I certainly was very active in the second time of the runaround with the tech scene, and certainly had much more capital to play with in the, call it 2010 to 2015, as we've seen a lot of this rise over the last period of time. And that's really where I got involved on the artificial intelligence side, battery technologies, and a lot of these different pieces where I felt that I've had a pretty significant edge on the market and just understanding how the tech works and being able to read through or see through a lot of the marketing hype versus what's, legitimate technology that's actually driving value. I think that I say it a lot of times that fintech and what we traditionally called fintech from that period is really just front-end development. It's making, as we talked about, and as I've always put a big focus on, and our team puts a ton of focus on, is the user experience, is making that process more efficient. The problem with solely focusing on front-end design and development, like with Plaid or any of these types of solutions, is that it's not actually revolutionizing or not actually changing anything on the back end. So the bank systems, the transfer, the technology used by the SWIFT network, none of that is really being changed at all. And so fintech really doesn't solve any of those problems. It just solves the front-facing retail thing, which is why I think, from my perspective, the average person won't actually experience a new or significantly different experience with blockchain systems, because the blockchain doesn't do anything on the front end. Maybe it provides you with new investment opportunities from a security token perspective, or maybe it offers new, functions from a DeFi perspective. But the actual interface itself has nothing to do with blockchain technology, right? What blockchains provides is a cheaper cost of capital, or reduced cost of actually having to do things, both in terms of actual dollar cost, as well as the time that it costs to do these things, to execute, to settle these transactions. And then, of course, it streamlines that pipeline from a banking perspective, right? I like to use the example, somebody said it a million years ago, and I don't remember who, but if you swipe a credit card, there's 10, 15 different banks and providers that are involved in that process, especially if you're international or if you're somewhere else outside of your home country. You're swiping that bank, the credit card processor deals with it, the company that's actually selling the product deals with it, then they distribute to banks, they distribute to providers, and everybody's taking their cuts, right? The blockchain either reduces by removing specific middlemen from that process, which cuts out their specific fees, or it automates a lot of that process so that those fees get distributed much more efficiently. So again, what that translates to a user is nothing tangible except for either a cheaper rate on their credit card fees, or a cheaper transaction fee to the actual company or the store itself. But the actual experience of swiping your credit card, whether you use it on blockchain rails or non-blockchain rails, is exactly the same. And so I think a lot of skeptics will say, like, oh, well, why is blockchain changing my life? And it's like, well, maybe it won't viscerally change your life, but it certainly makes things a whole lot less expensive for every provider across the ecosystem, which results in more capital, which results in cheaper fees and more accessibility for the traditional banking and financial ecosystem, which I think is really the main use case for blockchain technology.
Yeah. Well said. Well said. I will share you my late 90s .com experience. So I had a failure and a winner. So Just like Amazon, we had our own version here called Jumbo Mall. It was an online shopping platform, all hyped up on a IPO with hyper values based on blue sky. That failed, right? But I had a winner, because anything you put on, even if you put $1,000 or $5,000 on these IPOs, they were bound to, when they listed, they were bound there, just like these guys experienced. But I had actually one winner called Melbourne IT. It was very new. It was our first domain registration platform here in Australia. You could actually buy a domain name on this Melbourne IT platform. So they floated. I had $2,000 on it. First day of float went to $40,000, and obviously you got to take some common sense and cash in those 40,000. So that actually helped fund my accounting firm back in 2000, the year 2000. So again, that's it's obviously we all had different experiences, but I guess the point of that, in talking about that era, the .com era, the bubble that had happened and it burst, is that we went through that reset moment. And I think, as I said, I think we're going through that now, where from a blockchain perspective, it's weeding out the cowboys. And the good projects will stay there because the fundamentals are there. And people, obviously, in terms of trust and all the things that goes to with being great projects. And I think this is what we're going through at the moment. Weeding out the cowboys, and the good projects will survive and will thrive in the environment that we're in. Probably just on the sort of wrapping up, but in terms of just sort of finishing thoughts, lasting thoughts, Klaus, to start with you, and give us your sort of closing thoughts on today.
I think we covered a lot of topics, and I really liked a lot of the points that got addressed. So yeah, no further comment, except that I have another call pretty soon.
Take your hot pass, yeah. No, thank you, Klaus. Tron, closing thoughts.
Yeah, I just want to say, I'm a big fan of both crypto and the tokenization of assets, and I do think they mate together well. I think one of the things that we'll find is that, at least in the short term, that the people who do have crypto and understand kind of the changes that are happening will be the first ones that want to purchase tokenized assets, because they understand kind of the two technologies or whatever. And then the other thing is just that this is a new technology, and the legal framework that we've talked about kind of is behind, and it hasn't been updated to kind of take advantage of how this stuff works. It's the fact that this ledger kind of works by itself, and all of our laws are kind of related around kind of the intermediaries or whatever. So there's kind of this mismatch and this grinding. So I look forward to kind of seeing how that kind of resolves itself. But usually a technology wins, Netflix over Blockbuster, that type of thing. And I think that transition will happen over time, hopefully sooner than later.
Fantastic. Doug, closing thoughts?
Sure. I mean, look, I really enjoyed the discussion. I thought everybody made some great points. I think the thing that I'd like to close with is, I think we need to come back down to basics in this space. There's a lot of money floating around the space. There's a lot of different things happening, but in reality, what is it that we're here about, or at least I'm here about, which is sort of facilitating the benefits of a peer-to-peer exchange of value in the case of Bitcoin and assets in the case of other chains. Now, you've got many other things that blockchain can do, but to me, that's the essence. And I think that's enough. There may be many other things that we can do, but that's enough. I mean, you think about how big things can start from little places and how early we are. I mean, I lived through an epoch, and many of us did live through an epoch where one day some company put up a little white screen that had nothing on it except for a box. And you typed in something in that box and boom, information popped up. Now, that's one of the biggest companies in the world now, right? That's bigger than meat space companies that have been producing things for 200 years. It's Google. So massive, huge, life-changing, world-changing things can start from small places. Blockchain is not in a small place now. It's about the size of, an average bank. The whole of blockchain is about the size of an average bank, big bank. But over time, as Tron said, technology wins out. And the tech is good. It's worthwhile tech, and it's good tech for a number of use cases. So let's just keep the focus on sort of what's the core of what we're doing, and just keep trucking along. That's my closing thought.
Fantastic. Kyle, closing thoughts from you?
Thanks again to all of you guys for hosting this space. Shout out to the Ravencoin community and everybody doing great stuff. As I mentioned, the RETech course, which is real estate technology, it's our first course that we spent a ton of time on. It's 10 hours of some of the highest quality real estate education you can get in the industry at your own pace with multiple modules. We're really getting involved in teaching. The Black Friday discount is currently live. If you use Black Friday as one word on stacourse.com, go now, purchase that. It's only live through the end of the week. So definitely get that if you're interested in learning more about tokenized real estate. And then you can find out more on trading prices and stuff, stm.co.
Fantastic. Well, guys, I really appreciate your time, giving up your time in terms of being part of this session. Actually, Klaus just sends his apologies. He had to get into another call. So thank you, Klaus. If you're listening and recording, Tron, really appreciate giving up your time. Doug, Kyle, again, really deeply appreciate your time. And again, this is obviously as a collective, we're all trying to educate, provide awareness in terms of what's happening in our industry. And I think this is just playing a small part in terms of doing that. So again, thank you so much. Have a great afternoon, evening, depending what part of the world you're at. And it's almost going to be midnight soon, so I better get some sleep because I got the show tomorrow morning. So talk about consistency, Kyle. The show must go on tomorrow morning.
Show must go on.
That's it. Well, thank you so much, guys. Take care.
Thank you.
We'll speak soon. Bye-bye now. See you.
Thank you. Bye-bye.
Bye.